Good afternoon, everyone. Thank you for being here at this session, Opening Doors, Affordable Home Ownership Strategies. My name is Michael Cox. I'm the Deputy Director at the Whatcom County Library System, and I'm moderating this panel about home ownership. It's more than just a place to live. It's a powerful tool for building generational wealth and financial stability. Unfortunately, home ownership can feel out of reach for many. This panel will explore resources and creative solutions to some of the challenges facing homeowners today. I would like to introduce our panelists. To my left, Nate Wally. Nate is a residential loan officer with WECU in Bellingham, Washington. Nate has over 10 years of residential loan origination, helping clients find their first home, their dream home, or an investment home. One of his specialties is helping first-time home buyers realize the dream of home ownership and the path to building generational wealth. So Nate, thank you for being here with us here today. And David Ellsworth Keller. David has worked with the nonprofit Affordable Housing Organization since 2008 and has served as the Colshan Community Land Trust's Home Ownership Program Director since 2020. He's helped homeowners and home buyers navigate the process of purchasing or selling their homes on over 180 community land trust transactions. Thank you for being here, David. So I'm going to start us off with questions. We'll just share our time here, and then we may have some time for questions from the audience in a little bit. But I'm just going to get us started off. What challenges do people face? What challenges do people face in successfully accessing home ownership opportunities? And as kind of a secondary question there, what systemic obstacles do you see in your work? So challenges and systemic obstacles.
And Mike, ooh, I can even pull it away. I might not even need it, right? Okay, so I'll hold it. Let me find the sweet spot. So I don't want to steal any of your thunder, Nate. When it comes to challenges, I think there's a temptation, rightfully so, to focus on, for thinking about barriers, purchase, like looking at a home for sale and just like focusing on the purchase prices and the interest rates. Those are definitely things that demand attention. I think also, though, starting at just like the cost and availability and stability of rent. Like, so starting there, if you're talking about like a first-time home buyer, the cost of rent. So one, the rent is too high, and so there's a substantial proportion of the residents of Whatcom County who are cost burdened. They're paying more than a third of their gross monthly income towards the costs of rent. When you're renting, there's a certain degree of instability. You never know when the landlord could increase your rent, choose to not renew your lease, sell to someone else, and there's some uncertainty as to whether or not they will maintain your home. And so, like, starting, I think, like, if you want to hit price and rates, I'll start with like just like the instability and the costs of rent.
Yeah, I think. Is this working? I think you're right. I think that's definitely an issue. I have people in my office every day whose entry into thinking about buying a house is that their rent has been raised again and again and again, and they absolutely can't afford to live. And then they come in and get even worse news from me. But I think that an impediment to what we have is a lack of education. It seems that I spend a great deal of time just sort of demystifying the process. It can be overwhelming from the outside, but there are resources available, and I guess we'll talk about some of those today. The state has some exceptional resources, and so that's an issue. I think there's issues, from my perspective, there's issues in the way things we can't really change, the way the government regulates, the rules around qualifying for a mortgage. Fannie Mae and Freddie Mac, the two large underwriters of loans in the country, have rules that, if you look at them today, I would suggest they're causing more harm than good in some cases. An example that we just met actually for the first time, and they do great work. But one of the things that we talked about earlier was allowing a first-time, any buyer of a home, a single family residence, to rent out a room and use that rent to qualify for the mortgage. Can't do it. You can rent the room out and effectively save money, have somebody else share the payment with you, but that does not help you qualifying. And that's an old rule that does not, I think, reflect the reality that we have today in the United States. Now, can we change it? I don't know. That's not my. I live by them. I'm not sure I can change them. But there are some strategies we might be able to use to get around that. One of those is, and one of the things that I'm seeing every day is more people coming together, friends or family, and buying homes together. And we've seen this. I've worked in the Skagit Valley I'm from the Skagit Valley for most of my life, and we see this heavily in the immigrant community in Skagit Valley, where you have brothers, sisters, friends, family members buying homes together and living in them together and growing equity together as a way in. And I think we're going to see more of that as time goes on.
I'm willing to just talk a little bit more to the barriers. And I feel like I might have to adjust to the location of the microphone every time I turn it on. So I know I said I wasn't going to talk about home prices, but how can you not? So we all know, my expectation is that many of us know that the median home price in Bellingham and in Whatcom County at large is really high, but not just the median price, but what have historically been the more modestly priced homes, what have been traditionally called entry-level starter homes. Those costs are really high, and when you combine that with interest rates, right now, if someone was to get a 30-year fixed rate, so not an adjustable rate mortgage, which there are situations where an ARM can work, but if you were getting a 30-year fixed rate, those interest rates are over 7%, and even some of the more accessible homes, purchase price wise, if it was a condo, condos also have a certain they have condo dues that need to be considered when you're thinking about that home buyers, what's called their front end ratio, their principal, interest, property taxes, homeowners insurance, and so those dues and the possibility that there could be a special assessment in the future, it makes even those entry level homes harder to access because of what the PDO payment would be.
I think people are very surprised to understand that it can oftentimes be harder for them to qualify for a condominium than a single family residence, and it doesn't, in your head, it doesn't make sense. But when you peel back the onion, some of the homeowners association fees are $500-600 a month, and that adds into, you have to qualify for that as part of the payment. So another barrier.
So maybe you could purchase the home for under $4, potentially.
Potentially.
But there's association dues.
Yeah.
Good. So we're spending our time, and we have a couple more minutes if we want to dig deeper into any of the problems, surfacing the problems and the barriers, and then we'll get to talk a little bit more about some of those solutions, which is maybe really why we're here. But any other problems or barriers that the audience wants to throw on the table for us to be considering? I mean, that kind of hits it, right? Costs and interest rates.
So in order to qualify,
I've got a camera going.
So in order to qualify for for a Fannie or a Freddie product, 620?
Most lenders have a 620 minimum.
And we know that there's a number of factors that can contribute to why someone could have a credit score that is below 620. But in order to qualify for a conventional mortgage, to get having positive credit history is a necessity.
Thanks for bringing that one up. Shall we turn to solutions? Can you please share some effective strategies, resources, industry trends that help individuals overcome one or some of these barriers?
Sure. I think between us, we probably can cover most of the ground that at least I know of. There are some resources I talked about earlier, the state having resources. The state has quite a few programs. The Washington State Housing Finance Commission offers down payment assistance loans for those people who don't have any money to put down on a property, which can be a huge barrier because you're in a home, you're renting, the rent is high, there's no money left over to save for a down payment. It offers a first mortgage, Fannie Mae or Freddie Mac or FHA backed loan for 97% of the purchase price. And then the state will give a 0% second, which you don't make any payments on, and you pay off when you refinance or sell the house. And that'll amount to 3 or 4% of the loan amount. And so it's effectively a 100% loan. And that coupled with the ability to we're starting to see in this market the ability to negotiate seller concessions for closing costs. We literally have people who are able to buy a house with nothing down. And that opens a lot of doors. The other great thing about the program is there is a really, with a lot of these programs, is an interesting kind of catch-22. A lot of them are really good, but you can make too much money. Some of them are really good, but maybe you don't make enough. That's like with USDA. This program with Washington State has an income level of $180,000. So a lot of people will qualify for the program that don't qualify for anything else. Why don't you talk about those other ones?
So as Nate stated, the Washington State Housing Finance Commission. So every state has its own housing finance agency. I think in our state, the commission is like, it's this like pseudo, it's not exactly a government arm, but it is like a lot of the funding does come. It's some of it is bond backed. This is not what you're here for. So they have, first of all, they have a homebuyer education workshop that is geared towards first-time homebuyers. So that is a great place to start. If someone is looking for pre-purchase homeownership information, the curriculum is pretty solid. It is definitely geared towards a first-time homebuyer, and it's from starting to think about purchasing a home all the way through financing, looking for a home, and then you can follow that up with like one-on-one counseling, maybe like budget counseling with a HUD certified housing counselor. So that's available through the Washington State Housing Finance Commission's website. They also have, as Nate was speaking to, there's like a number of loan products that they offer, and sometimes like first mortgages. So these are the primary mortgage that helps someone purchase a home. Several products that are geared towards first-time home buyers. To meet that criteria, you have to have not owned a home in the last 3 years, like a primary residence. There's a couple of exceptions to that. I would recommend like going to the commission's website if you have any questions for like what they offer and how. They do offer what's called like a house key opportunity first mortgage that has really competitive interest rates. So at a time when interest rates can be prohibitive because they're relatively high compared to where they have been. There's some products intended for households, specifically first-time homebuyers below 80% of AMI, where the interest rate is relatively low relative to other like prevailing rates. They also administer I don't know if anybody has been following the Covenant Home Ownership Act in Washington State. But if you yourself or an immediate family member, and for more, did I? No. If you or an immediate family member can prove that you lived in Washington State prior to April 14th, 1968, you could be eligible for what is essentially like a deferred loan that is now, I don't know if anybody followed after this last legislative session. This money, it was a deferred loan that it could be either $150,000 up or 20% of the purchase price, whichever was greater, if you yourself or a family member had been impacted by racially restrictive covenants. And they have a lot more information. I'm not going to share more than I think is my like one that I have time to share and than I should. But at the end of this last legislative session, it was turned from being like a deferred loan to a forgivable loan. So if someone got this one up to $150,000 or 20% of the purchase price, up to $150,000, and you live in the home, it's your primary place of residence for at least 5 years, then it's forgiven. but you have to be below a certain amount of AMI. You have to have had, you yourself or a family member has to have lived in the state of Washington prior to April 14th, 1968. And they have to have been a member of one of the racial or ethnic groups that that is the criteria for this product. So there's a variety of products. I want to like pass it off if you want, and then take it back.
I'll just quickly go through some more. There is a USDA product that is a zero down loan. It's intended for rural development, and so, for instance, you have to qualify as a buyer based on income. The home has to qualify based on where it's at. There's an eligibility map online, very easy to use. So to just sum it up as best I can, Bellingham would not really qualify as rural, but East County would. And it's a fantastic program. The rates are really good, and it is truly a zero down loan. That is a real resource. And then Fannie Mae, the conventional program, they have a program called Home Ready, where if you qualify from an income standpoint as a first-time home buyer, not having owned a primary residence in the last 3 years, you can put as little as 3% down instead of 5%, which is a normal conforming loan, and the rates are significantly better than the market rates for a 30-year fixed-rate loan. Other strategies are ARMs. You touched on ARMs for a minute. ARMs are have been kind of a dirty word. They freak people out.
Adjustable rate mortgage.
Yeah, adjustable rate mortgage. Sorry, they can scare people, and rightfully so. I think I'm old enough that I clearly remember 2008, and we almost destroyed the world economy. But ARMs are sneaking back into the marketplace, specifically the 7-year ARM, where the loan is based on a 30-year amortization, but the rate stays fixed for 7 years. The first 7 years, it doesn't move. It can adjust after that, and probably will. I'm conservative, so I would kind of bet that it would adjust. But for the first 7 years, you're fixed rate. And the rate can be up to, sometimes on a daily basis, a full % lower than the 30-year fixed rate. A little easier to qualify. So those are some options that are out there that if you have a VA benefit, that's another 0% down loan. The VA loans are spectacular for first-time home buyers. Definitely an asset.
That's a good question. Sure. You mentioned that even qualifying for some of these programs has its own barriers, maybe above and below. Your income might be too high or too low. Generally speaking, what's that income level that these programs are looking to support?
I can speak to some of that. And so in general, and this is kind of like a Washington State thing, and it depends on the specific, like, what are we talking about? Are we talking about down payment assistance? Are we talking about like a first mortgage product? Like, there's a number of different products. They are almost all capped at 80% of AMI. So, like, to give you an idea, like, as of June the 1st, there's going to be some new numbers for the city of Bellingham, where, like, for a household of 4, 80% of AMI is $86,700. A lot of them cap it both, like, there's like a max amount that a household could earn, and in many instances there's also a minimum amount as well. And so we could talk a little bit about, like, sometimes I know, like, for the city of Bellingham's DPA, it's capped at 50% of AMI. Like, you can't earn less than that unless, like, with like a couple of exceptions, either that household is purchasing a home where there's some amount of sweat equity, like through like a habitat purchase, something like that, or if somebody had low income but was offsetting that with high assets. So if somebody was putting $75,000, like, if their income was low and fixed, say they were retired, and they could put $75,000 down, then they might be allowed to do it. But I would say normally I see it constrained, like 80% is the cap. And I could speak a little bit to, like, there's a couple of nonprofits locally here in Whatcom County that do more affordable homeownership opportunities. And the first two are not my programs, and so like I am less confident to speak to those. I would encourage you to Google them and then find out what their requirements are. One is Whatcom Skagit Housing. I believe their wait list is closed. I believe there's a substantial amount of sweat equity hours that a home purchaser through Whatcom Skagit Housing would have to complete. But once they've done so, they own the home free and clear and could sell it on the open market, is my understanding. So there's no restrictions what they could sell the home for, but there's a substantial amount of sweat equity that the home purchaser must complete prior to closing on the home. There's also Habitat for Humanity in Whatcom County. As well, I would encourage you to Google them as well. And then, so I work for Colshan Community Land Trust. The Community Land Trust homeownership model is based on permanent affordability. So not only is a home affordable for the initial purchaser, but it remains affordable, and it does so through there's a ground lease, there's a restrictive covenant. If it's a condo, there's some legal form of capping what the homeowner can sell the home for, and it's through the program to another income eligible household. And the whole purpose for the restriction is balancing some of the benefits of owning a home, which one is like the kind of stability that comes when you don't have to worry about renting and having your rent increased or your landlord not renewing your lease, that kind of instability that you have when you rent. And then also like some asset creation, like some getting to enjoy some wealth creation. So you earn equity through a community land trust normally two ways. One is like as you pay down your first mortgage, as that homeowner pays down their first mortgage, that's less that they have to pay off in the end when they sell, so they earn equity that way. And then there's always some form of some formula for the resale that would give some sort of additional return for that home buyer that gives them hopefully a fair return while keeping the home affordable for the next buyer. That's enough, perhaps, of an introduction to that.
And it's a wonderful program. It is. They've helped part of my family, so it's a fantastic program. I can testify to it.
And so I guess the result of something that caps what a home could be sold for means that the next person in, it could really be for a price that is kind of out of touch with the current market, I suppose, or
100%. Like the whole point of the community land trust homeownership model is not only as like a corrective to certain market realities. Like in our market, the median home price is so high that it's out of reach of most households, right? Like you could earn like 180% of the area's median income and still be priced out of the median home. So not only is it a corrective to that, but it's also an alternative to that. The idea is like not only like taking homes out and making them affordable, but like keeping them out of the market so that we as a community have some sort of guarantee that home will be affordable like in perpetuity, permanently, that like we know the more community land trust homes there are, the more affordable homes there are for the community. So we make and then retain that affordability over time.
How many community land trust homes are there?
In Whatcom County, there's 142, about to be 146, and we've got a pipeline where there are 18 more homes in Bellingham in the next couple of years, potentially 50 in Ferndale in the next like three to 4 years, maybe a little bit less than that. So, and then statewide, there are at least 20 community land trusts. Nate and I were talking beforehand. There's a community land trust in Skagit County. I would say we're getting to a point where many, if not most, of the counties in Washington State are served by a community land trust.
And do you have more than, do you have 200 people in line knocking at your door right now?
We definitely have a lot of interest. We have a pool of applicants where there's over 60 households, and it really just depends on like the specific home. Every home, the homes are sold based on the home and not necessarily the household purchasing it. And so the price of the home is what the price of the home is. And then like different households some might want a condo, some might want a single family home, some might want to be in Bellingham, some might want to not be in Bellingham. And with a variable variable costs. Like it really depends on the specific opportunity to purchase a home, and it can be challenging to predict. Of those 142 homes, whenever one resells through the program, it's dependent on when the existing homeowner decides that they want to sell and move on to their next home, and so it's hard to predict. So I would sometimes it depending on the household, it could take them multiple years to purchase through the program, or if it was just like the right moment in time, it could take them months. So,
Thank you. That's fascinating. Well, we've been ticking down the list, responding to some of those barriers. Anything you can do about the escalating prices of homes? I mean, I guess you just spoke to that. That's a different system.
and I could speak a little bit to like some of the more specifics of a community land trust home ownership. So the home price through a community land trust is generally, I would say, like here in Bellingham, probably at least half of what the fair market value is. So like instead, and it's not exact. It varies from home to home, and they might be like a third of like what that home would be selling for if it was on the open market. So one of the benefits of purchasing through a community land trust right away is that like dramatically lower purchase price, right? Much lower, and then you have access to some financing, like some mortgage products that you wouldn't have otherwise. There's also you don't have to pay private mortgage insurance because the lender acts as if. So if you don't pay, if a home purchaser, and Nate, you're gonna have to keep me honest here, if you're not paying 20% of the value of the home when you purchase it, you're gonna have to pay mortgage insurance.
One form or another. Yeah.
And it protects the lender, not the home buyer, in the instance of default for the home buyer. And so, but PMI or mortgage insurance can be anywhere from and it depends. It varies on like credit score, hundreds of dollars. So if you're not putting 20% down, so in order to qualify, you kind of alluded to this earlier when you talked about that one mortgage product, the commission, where there's the first and then there's the second for 3%. So in order to get a 30-year fixed rate, like conventional mortgage, like a Fannie product or Freddie, you have to put at least 3% of the purchase price down. And so that can be a huge barrier, right? Is just coming up with 3% of the purchase price, and that's just to get like a 30-year fixed rate mortgage with the rates as they are. And then you're going to have to, and if you're only putting 3% down, you're going to have to pay mortgage insurance, which could potentially add hundreds of dollars to your monthly housing cost until you have paid your first mortgage down enough to equal 20% of the value of the home. And so with a community land trust, you do not, so one, the purchase price is dramatically lower than the fair market value. You don't have to pay mortgage insurance because the lender acts like the difference between the fair market value and the buyer's net purchase price, what they actually have to pay for the home, kind of counts as that money down. And so you don't have to pay mortgage insurance. In Whatcom County, your property taxes are actually, you are assessed not at the fair market value for the home, but you are assessed fairly at what you could sell the home for through the program. And so your property taxes are dramatically reduced. Instead of paying, I think that's another barrier to just being a homeowner, is like there's certain costs that you cannot control. Even after you've purchased a home, one would be property taxes, another would be homeowner's insurance. We can't do anything about homeowner's insurance at the moment. That is what it is.
They never go down.
Yes.
They're only going up.
For us, like the property taxes are tied to what that homeowner could sell the home for through the program rather than the assessed value, which is always going to be closer to the fair market value. So you're saving, the purchase price is lower, which means you're paying less interest on it. You don't have to pay mortgage insurance like PMI or MI, and your property taxes are also significantly lower if you own the exact same home on the open market.
So we've talked a lot about today, a lot of barriers, some solutions. What it's forced me to become in the business is kind of a resource aggregator. And this is the approach, this is why I work at WeCoo. This is the approach that we take to our community. And that is a person by person focus on each person's puzzle of buying a home. And I'd like to sit here and say that as a lender, I could help everyone, but I can't. Not one lender can service everyone. But if I sit down with someone for a half hour or an hour and I walk through their particulars and we build a profile. If I can't help them, I can get them face to face in the next couple of days with someone that I know can, and I've seen them do it before, and they're a trusted resource. And so that's what I encourage everyone to do. I brought cards. Is reach out, because there is no kind of generic there's no generalization. It's very specific to each person, their credit, their down payment, their strategies, using a cosigner, getting a gift, buying a house with a friend. One of these programs, innovative programs that we've talked about, and WECU doesn't have them all, but we have trusted resources that do. So I encourage you to use us as a kind of a we'll sit down with people. Our focus is finding solutions for people. We have 180,000 members, which is kind of amazing to me, given the size of the county. And we are the largest residential home lender in the county. And so, every single day, I send people to a trusted resource because I can't help them. And we're still the largest lender in Whatcom County. So I think that's saying something.
Thanks for saying that. I mean, one of my questions for you is going to be, you mentioned lack of education as one of the barriers, and these are all the things where the gaps would be. You have to know this stuff to be able to take advantage of them. And if I'm just walking into any bank on the street, is it likely that they would point me in the direction of some of these resources, or just?
I like to think so. Yeah, I like to think so. I think as lenders, we're really used to the reality of not being able to help every person, and as salespeople, we're salespeople. If we send people out into the world with a solution, they're going to remember that much differently than if we just say, "Hey, sorry." It leaves a lasting impression. And I oftentimes end up sitting with someone, talking through a scenario, and building out a step-by-step process for them to buy a house. And 6 months later, it happens all the time. They're in a house. I mean, we set up a kind of a roadmap, and then they're in the house. Or I've sent them to another lender. They have a specific program, and these people fit, and a couple months later, they're in a house. And we just have to do that because the problem is that big.
Okay, well, I've been keeping track, and we started by listing a pretty long list of barriers. And one of them that you mentioned that we haven't really spoken to yet is this minimum credit score of 620. And so are there ways that we can maybe more quickly and easily improve our credit scores?
I can say one thing. So through the Washington State Housing Finance Commission, like through the Homebuyer Education, there's also like the one-on-one kind of budget counseling with a HUD certified housing counselor. And sometimes that, like in that counseling session, like that counselor can help their client, the household, get counseling on improving their credit. So if it's either like insufficient credit history or insufficient positive credit history, like increasing that score, there can be like that counselor could provide some guidance on increasing that credit score.
And we'll talk to people. Obviously, we're not credit repair specialists. That's not our job. But we work with our customers every day about credit repair, and credit is a very interesting thing. It's you don't use enough of it, your score goes down. You use too much of it, your score goes down. I mean, it's a double-edged sword, and there's a fine line there about how to use credit effectively to raise your score. When you do it right, the scores can come up very quickly. Getting things off of your report that shouldn't be there. You're utilizing the financial reporting folks, the aggregators of credit, will give out their information and numbers and help people get a hold of the various credit reporting agencies to get things taken off their record. We're removing the credit reporting agencies are removing medical debt from the credit reports, which is an automatic across the board lift to credit ratings in America, and that's been a long time in coming. So there are some strategies.
Nate, am I correct that like if a household was going to a lender to see what they could get pre-approved for, if they're like looking to see like where they were, that loan officer that they're if they were meeting in person, if that was happening, would they be pulling? They'd be doing like a hard pull, right?
But generally, on a pre-approval, what WeCoo does anyway, and most lenders do this, we do a soft pull for pre-approval, which is just we're pulling one of the three credit reporting agencies, and then we build a pre-approval from there. But then once you find a home and get under contract, to get a full approval, it requires a hard pull of all three agencies.
So when you don't, so you're not doing the tri-merge pull,
Right.
You're doing the pulling one, but during that time, but where it's a soft pull, you're still seeing, you'll see the if there are any, like you'll see the history, so they get
it's a full report from only one agency though.
And I would say like sometimes some households might not know what's on there, and if there
Right.
was something that was on the report erroneously that could be corrected or things like that. That's
Yeah, we start there. That's the first step, and we go through the credit report with the customer so that they can understand what's on it because they've never seen it. The credit reports that are available to us using Credit Karma or some of these online applications are nowhere near what a tri-merge credit report looks like. It is very, very, very thorough. And so they'll find stuff on there that doesn't even belong. It is not uncommon for us to find debts associated with a customer that aren't their debt.
100%.
And those are easy things to fix and easy things, and they will bring the score back up. There's a thing called a rapid rescore that we can do after cleaning things up to get a rescore. The reason it's so important, it's not just the minimum of 620 to get over the hurdle and get the loan. Most programs are your rate is based on your credit score. The higher the rate, we've got prime and subprime. The higher the rate, the better. The higher the credit score, the better the rate. The lower the credit score, the worse the rate gets. The wonderful thing about the Washington State program is it's a minimum entry to get into the program, but the rates are the same for everybody. Good credit, bad credit, the rates are all the same. So it's not on that same scale.
And you talked earlier a little bit about like FHA too, which also, when it comes to credit, I think FHA is a little bit more flexible.
FHA is a little more flexible. Some lenders will go down to 580. VA can be a little bit more flexible as well. VA is also flexible in some of their income calculations and work histories. So that's what I'm talking about. Every program is. I mean, there's a million nuances to all of them, and so we have to sit down and like look at your individual case and then make it fit. Every borrower that I work with, I think of it as a puzzle. It's actually interesting as a job. It's kind of like a solving the riddle.
Yeah. And I think you spoke earlier to education. I think that's what the education can and should include is so one, the homebuyer education. I think that's a really good place to start. That's geared towards first-time homebuyers. There's a lot of like useful information in there, but also like speaking with a loan officer, maybe multiple, just to get an idea, because they know of products that like someone might think like, oh, I need a 620 because that's what we just said right here, but actually like there's FHA and VA products that they might be eligible for.
You had said earlier that paying your rent doesn't help you qualify for a loan, but paying your rent, can it impact your credit score?
That's my understanding.
Yes.
Is that it's been changed.
You can. The laws have been changed around that, and you can. We can collect proof of rent paid on time from the landlord, and that can be given to the credit reporting agency, and that can be used as a trade line to positively impact the credit rating. Some of the things that I see most often is that just people have no credit. They don't use credit at all. It is not uncommon for me to sit, especially with seniors who haven't had a debt because they don't believe in debt, and they haven't had a debt in 20 years. So they haven't applied for a loan. They haven't had a credit card. They literally have no credit score. And so we have to start from the beginning from them, and we have some interesting ways of doing that. There are some products that we have at WeCoo that we can use that safely and quickly create what are called trade lines on their credit report and build a credit history.
And I think there's some products as well to build credit history for if a household like for religious purposes do not believe in in using a credit card or borrowing in that way. There are different products that have been created to like actually help build credit.
There are professional credit counseling groups. There are people that can credit repair groups. I think my advice for people with those is to really look at what you're doing and what you're getting and what you're signing up for. Many of them are ongoing subscription-based models, which people don't really need, and they end up paying $40, $50, $60, $70 a month while they work on their credit. And I find that it's interesting that it always takes 3, 4, 5 months for the credit turns around. Nothing's instant because they're kind of. I feel like they're dragging their feet. Not to besmirch their industry, but I think you just have to be careful.
Not all of those are created equally.
Yeah, it's true.
Thank you. I know we got a little outside of your industries. We're going to have some time for questions, and some were submitted to us upon registration. But maybe just real quick, is there something, maybe it would be a little slightly off topic, but just currently in your industry, something new that has you particularly excited or that is new that you're working on? I don't want to force it. We can jump into questions as well.
We could like think about it and return to it. I mean, there's a lot that's exciting to me. I just want to make sure it's also exciting to you.
I think I talked about the Fannie Mae rule about single family residences and not being able to use rental income and how that hasn't changed. A lot of rules are changing, and there are some new trends. Their income's being calculated differently. Credit is being calculated differently. Underwriting guidelines are being changed here and there to better reflect kind of the economic conditions that we're in. I think we're still a little behind.
I suppose this counts. I have seen an encouraging increase in a recognition of the importance of affordable home ownership opportunities just in general, but also like permanently affordable home ownership opportunities, specifically community land trusts, but like from the state legislature to the state agencies and like actually like funding it. So like there's an awareness and there's also a general desire to actually put real money to support it, and so that's been really encouraging in a way that is maybe like might not have been the case, and also like allies that might not have potentially been allies previously. I think a lot of business owners are seeing that like it's increasingly challenging to attract and retain staff if their staff cannot put roots down in the community. I think there's a lot of support that's coming from interesting places that maybe did not exist in the past.
Thanks for sharing that. This question came up a couple of times from those when they were registering for the session. And it has to do with combating the stigma of talking about money. So do you have any strategies for talking to those who might have experienced some financial trauma?
Well, I don't know if it's a strategy, but clearly some people are much more open to the conversation about money than others, and you do have to really work at prying some of the information out from people. But I think that if you've never, one of the things my daughter said to me one time was, "How come you never taught me how to balance my checkbook?" And I was like, "Oh my God, I never taught you how to balance your checkbook." If you've never been exposed to learning about financial things, it can seem daunting. And I like to, I said it at the beginning, I like to sit people down, and when I sense that's kind of where we're going, I like to just say, let's demystify this. This is not magic. This is simple math. I mean, really, I have a calculator that I bought at Goodwill. It costs 99 cents. That's what I do the calculations on. It's not difficult. And if we just step by step walk through it and kind of humanize it, I think people react positively to that.
I can say for HUD certified housing counseling, there is some trainings that have been developed for like trauma informed counseling and like different techniques and strategies. Some of that can inform some of what I do. But like as Nate said, some of it is maybe not making assumptions based on like what someone should or should not know, and presenting information in such a way that like there's no implication that like it should or should not have been had, and gauging, like allowing the household with whom you're working to inform like how you're presenting information and what information, and just not making assumptions based on who you're working with.
Thank you. I'm ready for some questions from the audience, if you have any. And if I hear a question, I'll just repeat it so that we make sure the camera hears it as well. Please. The question was about the point system for mortgages.
That's one that everyone's mystified about. It's origination points, or other people call it discount points, and it has to do with the rate, the interest rate that you get on the loan. At the point where you're ready to lock a rate in on a loan, when you're talking to someone like me, you get to make a decision about what you want your rate to be. Rates are on a sliding scale. So there is a rate that it comes across, it's called a par rate, that has no origination or discount point. Then there's a rate you may choose to pay some money to buy that rate down, and take that interest rate down and save money on your monthly payment. You may choose the other way, to take a slightly higher rate, and the lender will give you a credit towards your closing costs. A lot of people don't know that. But it becomes for me a math exercise that I do with the borrower to understand what are we paying and what rate are we getting in return, because absolutely nothing is free. And so all you're doing when you buy down the rate is you're prepaying the interest. And so what we need to do is understand, if I pay, say, $3,000 to get a quarter point less, and I save $20 a month, well, if I divide 3,000 by 20, that tells me how many months it takes to break even. Most of the time when I do that math with someone, they go, no, I'm not doing that. Because it comes out 6 years, 7 years. It'll be a long time before you break even. And if you sell that house or you refinance that loan, the money that you invested in getting that better interest rate is gone because you don't have that loan anymore. And so it's something that I walk through with we don't have any set origination fee at WECU. We talk through that with each borrower and look at the ramifications on the payment, and just do the math so that we take kind of the mystery out of it. Some lenders simply quote rates by saying, oh, it's 6% at one point, meaning you're going to pay 1% of the loan amount in a fee. Well, what if we want a higher rate? What if we want a lower rate? What's that cost? So anyway, I don't know if I explained it.
Thank you. It's time to wrap up our session. You'll still be around to take some questions if you want to come on up and speak to them at the table. But Nate, David, thank you for being here today.